Hi, my name is Tory Garber. I'm a financial advisor based in Las Vegas, and I am proud to sit on the UNLV Graduate College Financial Wellness Advisory Board. Tutorial 1. What are pensions, 401ks, traditional IRAs, and Roth IRAs? A pension is a benefit, usually money, paid regularly to retired employees or their survivors by private businesses and federal, state, and local governments. Employers are not required to establish pension benefits, but may do so to attract qualified employees. A 401k is a tax-advantaged, defined contribution retirement account offered by many employers to their employees. It is named after a section of the U.S. Internal Revenue Code. Workers can make contributions to their 401k accounts through automatic payroll withholding, and their employers can match some or all of those contributions. The investment earnings in a traditional 401k plan are not taxed until the employee withdraws that money, typically after retirement. In a Roth 401k, withdrawals can be tax-free. Individual retirement accounts, or IRAs. Both traditional and Roth IRAs are ways to save for retirement that gives you tax advantages. The same combined contribution limit applies to all of your Roth and traditional IRAs. Contributions you make to a traditional IRA may be fully or partially deductible, depending on your filing status and income, and generally, amounts in your traditional IRA, including earnings and gains, are not taxed until you take a distribution or withdrawal from your IRA. You cannot deduct contributions to a Roth IRA. If you satisfy the requirements, qualified distributions or withdrawals are tax-free. IRAs can be opened even if you have a 401k at work. However, depending on your individual situation, you may or may not be eligible for tax-advantaged contributions to both of them in any given year. You should consult with your tax preparer. Several questions that I get. One is, which is best for me? Saving for retirement in a tool with tax advantages is a smart plan. As to which option is the best for you depends on your individual situation. When an employer matches your contributions, they add a certain amount to your 401k account based on how much you contribute annually. The most common way employers determine matching contributions is to match a percentage of an employee's contribution up to a certain limit. Not taking advantage of an employer match is the equivalent of leaving free money on the table. If you work for an employer that does not offer a 401k, you can start an IRA. If you are self-employed, you have additional options to save for retirement. The various plans have different tax treatment, so make sure you understand the tax implications of your particular plan before you sign up. Another question, should I invest by myself or hire a financial advisor? Stock investing is something that can be learned, but it takes time, dedication, and discipline. Whether you should do it yourself or hire a professional depends on your level of financial knowledge, interest in financial matters, and time available to dedicate to study and track the market. Hiring someone that does this work every day could be beneficial. A financial advisor can also act as your coach, so you make thoughtful decisions rather than emotional ones. Another common question, what information should I consider when choosing a financial advisor? If you decide to hire a financial advisor, interview them to learn about their experience and the team you'll be working with. Also, find someone that listens to you and is a good personality fit. You can go to www.brokercheck.finra.org and put in the name of your financial advisor. It will tell you how many years of experience they have, the firms they have worked at, the number of exams passed, and the states they are licensed in. There is also a disclosure section that includes information about customer disputes, disciplinary events, and certain criminal and financial matters on the broker's record. Another question, what fees are associated with hiring a financial advisor? Some financial advisors charge a commission based on the product you purchase. Other financial advisors charge a fee based upon assets under management. Still others charge a fee to build the plan and give you the option to who manages it. It could be them, you, or another firm. Most advisors are very clear about how they get paid. If you aren't sure, ask. The fees should be listed in account paperwork. Make sure you read what you are agreeing to before you sign it.